October 19th, 1987. Black Monday. The Dow Jones crashes 22% in a single day. President Reagan stands before cameras, reassuring Americans that the economy remains fundamentally sound. Behind him, unseen by the public, Treasury officials frantically work phones. They're not calling Congress or the Federal Reserve. They're calling bond traders. The calls matter more than the speech. The bond market had already decided Reagan's fate months earlier. Presidents think they control economic policy. The bond market knows better. This is another story where money, power, and history collide. Nothing is ever as simple as it looks. Every American president since the 1970s has learned the same hard lesson. You can command armies, sign legislation, and shape foreign policy. But if bond traders lose confidence in your fiscal discipline, your presidency crumbles. The bond market doesn't vote, doesn't lobby, and rarely speaks publicly. It simply prices government debt based on one question: will this administration's policies lead to inflation? Get that calculation wrong, and interest rates spike. When interest rates spike, everything else falls apart. Stock markets crash. Housing markets freeze. Businesses stop investing. Unemployment rises. The president who promised prosperity becomes the president who delivered recession. The bond market's power seems abstract until you see it in action. Government bonds represent promises. When Washington issues a 10-year Treasury bond, it promises to repay the principal plus interest over a decade. Bond traders buy and sell these promises millions of times daily. Their collective judgment determines how much the government pays to borrow money. If traders believe the president will keep spending under control, they accept lower interest rates. The government borrows cheaply. Economic growth continues. If they suspect the president will let deficits explode, they demand higher rates to compensate for inflation risk. The government's borrowing costs soar. The economy stalls. James Carville, Bill Clinton's political strategist, captured the dynamic perfectly. I used to think that if there was reincarnation, I wanted to come back as the president or the pope or as a .400 baseball hitter. But now I would like to come back as the bond market. You can intimidate everybody. The intimidation works through expectation and punishment. Bond traders don't wait for inflation to arrive. They price in what they think will happen based on current policy signals. A president announces a massive spending program without corresponding tax increases, and bond yields jump immediately. The higher borrowing costs act as an automatic brake on economic activity, often forcing the president to abandon or scale back the original plan. Consider Jimmy Carter's presidency. Carter entered office in 1977 with ambitious domestic spending plans and loose monetary policy aimed at reducing unemployment. Bond traders watched federal deficits grow while the Federal Reserve kept interest rates artificially low. They correctly predicted that this combination would generate inflation. Bond yields rose throughout Carter's term, reflecting traders' expectations of currency debasement. By 1980, the 10-year Treasury yield had climbed above 12%. Mortgage rates exceeded 18%. Economic growth collapsed. Unemployment soared. Carter, despite being a decent man with good intentions, became a one-term president largely because bond markets had priced his policies as inflationary disasters. Ronald Reagan understood the lesson. His 1981 tax cuts were massive, but he paired them with spending restraint and support for Federal Reserve Chairman Paul Volcker's anti-inflation campaign. Bond traders initially remained skeptical. Yields stayed elevated through Reagan's first year as markets tested his commitment to fiscal discipline. The test came during the 1982 recession. Unemployment reached 10.8%. Political pressure mounted for stimulus spending and easier money. Reagan held firm. He refused to pressure Volcker for rate cuts and maintained spending discipline despite the political cost. Bond traders gradually became convinced that Reagan would prioritize inflation control over short-term political considerations. Bond yields began falling in late 1982, providing the monetary accommodation needed for recovery. The economy boomed through Reagan's second term, not because of his charisma or political skills, but because bond markets trusted his anti-inflation credibility. Reagan's political success rested on bond traders' confidence in his economic orthodoxy. Bill Clinton learned this mechanism the hard way. During his 1992 campaign, Clinton promised significant infrastructure spending and universal healthcare coverage. After winning the election, his economic team presented sobering reality. Bond markets were already pricing in inflation fears based on Clinton's campaign promises. James Carville watched Clinton abandon his spending priorities in favor of deficit reduction and famously complained about being intimidated by bond traders. The pattern repeats across administrations. George W. Bush's Medicare prescription drug benefit and Iraq war spending contributed to rising bond yields in his second term. Barack Obama's stimulus package triggered immediate bond market concerns about fiscal sustainability. Donald Trump's tax cuts and spending increases faced similar market skepticism. The bond market's discipline extends beyond fiscal policy. Currency stability, trade policy, and regulatory approaches all influence inflation expectations. A president who threatens trade wars risks import price inflation. A president who promotes massive deregulation might face commodity price spikes. A president whose rhetoric undermines dollar confidence will see bond yields rise as traders demand compensation for currency risk. The mechanism creates a built-in conservatism in American economic policy. Presidents can promise revolutionary changes during campaigns, but bond markets enforce incrementalism. Radical departures from fiscal orthodoxy get priced immediately into government borrowing costs, creating economic headwinds that usually force policy reversals. The system also rewards perceived competence over ideology. Bond traders don't care whether a president is liberal or conservative. They care whether the president understands inflation dynamics and has the political skill to maintain fiscal credibility. A liberal president who demonstrates spending restraint can enjoy lower borrowing costs than a conservative president who loses control of deficits. The 2008 financial crisis seemed to break the pattern. The Federal Reserve's quantitative easing programs involved buying massive quantities of government bonds, artificially suppressing yields regardless of fiscal policy. Presidents Obama, Trump, and Biden all presided over enormous deficits without facing traditional bond market punishment. The respite proved temporary. When inflation returned in 2021, bond markets reasserted their traditional discipline. The Federal Reserve's attempts to normalize monetary policy drove yields higher, creating familiar political pressures. President Biden faced the same choice as his predecessors: maintain spending programs and risk bond market retaliation, or demonstrate fiscal restraint to preserve economic stability. The names change from administration to administration. The fundamental dynamic remains constant. Presidents propose, but bond markets dispose. No amount of political popularity, media support, or partisan control of Congress can override the mathematics of inflation expectations. Government borrowing costs reflect collective judgment about fiscal sustainability, and that judgment shapes presidential options more than any congressional vote or Supreme Court decision. The bond market represents the purest form of democratic discipline. Millions of investors worldwide continuously vote on American fiscal policy with their money. Their votes carry immediate consequences. Unlike electoral democracy, bond market democracy operates in real time. Bad policies get punished within hours, not years. The arrangement reveals a deeper truth about power in market economies. Political authority remains constrained by economic reality. Presidents can command respect, inspire loyalty, and shape cultural narratives. But they cannot command prosperity. Economic growth emerges from millions of individual decisions about spending, saving, and investment. Those decisions respond to incentives shaped by interest rates, inflation expectations, and fiscal credibility. Bond markets don't control presidents because traders are uniquely wise or powerful. Bond markets control presidents because they represent the collective judgment of people risking real money on economic outcomes. When political promises conflict with mathematical realities, mathematics wins. The bond market simply keeps score. Presidents who understand this constraint can use it to their advantage. By demonstrating fiscal responsibility and inflation awareness, they earn bond market confidence that translates into lower borrowing costs and stronger economic growth. Presidents who ignore the constraint discover that good intentions cannot overcome bad arithmetic. The bond market's influence represents both the power and the limitation of democratic capitalism. Markets provide real-time feedback on policy effectiveness, constraining political excess and rewarding competence. But market discipline also limits democratic choice, forcing elected officials to prioritize bond trader confidence over voter preferences. The system works as long as people believe government bonds represent reliable stores of value. When that belief erodes, the entire mechanism collapses. Bond markets can discipline presidents only if presidential policies still matter for fiscal outcomes. In a world of infinite money printing or currency collapse, bond market democracy becomes as meaningless as any other kind. Trust remains the foundation of both political and financial systems. Presidents govern through voter confidence. Bond markets function through investor confidence. When confidence disappears, both institutions lose their power to shape behavior and outcomes. The presidents change. The bond markets evolve. But the fundamental relationship between political promise and economic reality continues. Democracy may be the worst system except for all the others. Bond market discipline may be the worst constraint on presidential power except for all the alternatives.